Welcome to the Explainer. Today, we're putting on our sell-side equity analyst hats and getting straight to work. We are going to rigorously evaluate Generac Holdings, ticker symbol GNRC, by totally cutting through the market noise. We're going to build our case strictly on the raw fundamental data. You know, there's this absolutely fascinating tug-of-war unfolding right now between market sentiment and the underlying business reality. So let's break down the actual numbers and see what we're really looking at here.
Okay, let's dive into this. 97.56%. That is Generac's year-to-date return. Now, if you've just been glancing at their stock chart recently, you'd probably think this company is an unstoppable juggernaut. I mean, nearly doubling your money in less than a year? That generates massive hype for sure. But as analysts, an explosive stock chart is just our starting point. It's really just the invitation to look under the hood and see what's powering the engine. So here is our roadmap for this fundamental teardown. We're going to cover 1. The paradox. 2. Unpacking growth metrics. 3. The cash flow reality. 4. Evaluating multiples. And 5. Intrinsic value versus price.
Section 1. The stock market paradox, price action versus fundamentals. Now, as analysts, the absolutely crucial first step we have to take is separating the heat of a rising stock chart from the actual business itself. And this brilliantly illustrates exactly what I mean. We've got a 52-week low of 118 on one side and a recent close pushing 269 on the other. That is a surge of over 128% from its bottom. It's a massive cognitive gap we need to investigate. Because when you see a rocket ship trajectory like that, you expect the underlying business to be firing on all cylinders, right? But is it? Let's dig deeper. Section 2. Unpacking the growth metrics, historical versus recent. Let's peel back the layers of both the top and bottom line here.
We'll start at the top line with revenue. The 5-year compound annual growth rate, or CAGR, sits at a very healthy 11.11%. So historically, a really solid growth story. But look at the trailing 12 months. That TTM revenue CAGR is negative 2.02%. The historical trend looks great, but the immediate reality? Well, revenue over the last year is actually shrinking.
Now, what's really interesting about this slide is the bottom line. It reveals a progressively steep plunge. Over a 5-year period, net income growth is down 14.5%. Over 3 years, it's down 23%, and over the trailing 12 months, net income has plummeted by nearly 51%. Think about that. The business is becoming significantly less profitable at the exact same time the stock price is soaring. That is a glaring divergence.
Section 3. The cash flow reality. What's left over? Because while revenue and net income are great accounting metrics, we know they're subject to non-cash adjustments. Cash flow, on the other hand, is reality.
Just to make sure we're totally aligned here, when we talk about free cash flow yield, we are simply measuring the actual, literal cash left over after a company pays its bills and maintains its capital assets, divided by its total market value. Think of it like the cash return you'd get if you just bought the entire business outright today. For our valuation models, this is the ultimate measure of financial health. And for Generac, that free cash flow yield is currently sitting at an anemic 1.71%. To put that into perspective, that yield has plummeted roughly 58% below its own trailing 12-month average, and it's well below its 3-year average of over 4%. When you're paying top dollar for a stock, you generally demand a really robust yield, right? Definitely not one barely scraping 1.5%. Let's break that cash flow down a bit further. Over a 3-year period, the company's free cash flow growth was explosive, up over 126%. But what about the trailing 12 months? The actual cash generated was about $268 million, which represents a massive 55.65% drop compared to the previous year. So you have a stock price hitting the roof while the actual cash being generated has literally been cut in half. For anyone building out a strict valuation model, these are massive red flags.
Section 4. Evaluating valuation multiples. Pricing the engine. We know growth is slowing, and we know cash flow is dropping. Now let's look at relative valuation.
So the crucial point is exactly how much the market is paying for these slowing fundamentals. Right now, the market is assigning a price-to-earnings, or PE ratio, of 105.3. Investors are paying over 100 times current earnings. For context, Generac's 5-year average PE is 41. So the current multiple is 144% higher than its historical average. The market is pricing this thing like a hyper-growth tech startup, despite the fact that net income is down 50% year over year.
And hey, it is not just the PE ratio either. Look at the enterprise value multiples across the board. EV to EBIT sits at 57.6. EV to EBITDA is over 34. EV to sales is nearly 4. Every single relative valuation metric is telling us the exact same story. Honestly, at these multiples, you'd think they had just invented a new element, not reporting shrinking cash flows.
Section 5. Intrinsic value versus market price, the final verdict. Let's move to and see how this builds into our final objective check.
So here it is. Does the current stock price actually match its intrinsic value? This is it. We've looked at the history, the growth, the cash flow, and the multiples. Now, based on the strict, raw data we've just reviewed, what does a purely objective discounted cash flow valuation actually say? Well, the math reveals a massive disconnect. Driven by those plunging cash flows we saw a minute ago, our strict discounted cash flow fair value price comes out to $157.13. Yet the market's enthusiastic pricing sits way up at $269.41. The market is currently pricing Generac at nearly double what the strict fundamental discounted cash flow reality suggests the company is actually worth.
And that brings us to the stark conclusion of our fundamental teardown. As a value investor, you always want a margin of safety. You want to buy a dollar for 50 cents. But here, the margin of safety is negative 71.46%. Right now, investors are essentially trying to buy 50 cents for $1.50. You are paying an absolutely massive premium for a company with shrinking revenues and halving free cash flows.
Which leaves us with this final provocative thought. Will market momentum outrun fundamental reality, or will gravity eventually take hold? We've got an explosive stock chart, completely detached from the cold, hard fundamental data. It is a really fascinating standoff, and it truly highlights why we always have to look beyond the price chart and run the real numbers. Thanks for joining me on this explainer, and keep analyzing.